Picture this. You have a trade idea that feels clean. The chart lines up, the news matches your thesis, your friends are talking about it, and you can almost taste the win. Then the market moves against you a little. You tell yourself it is noise. It moves a little more. Now you are staring at your screen, not thinking about the idea anymore, thinking about the size. The position is so big that a normal pullback feels like a crisis. That moment is where most trading careers end, not because the idea was bad, but because the sizing was reckless. Position sizing is the part of trading that decides whether your edge gets a chance to show up. Edge means a small, long-run advantage, like a casino has in roulette. You can have a good strategy and still go broke if you bet too much. You can have a mediocre strategy and survive if you bet small enough. Survival is not a motivational phrase. It is math. If you run out of capital, you lose the ability to play, and the market does not care how right you were going to be later. Most adults understand this in normal life. You do not bet your whole paycheck on one hand of cards. You do not drive 120 miles per hour in the rain because you are late. Trading is the same. The problem is that markets reward confidence in the short term and punish it in the long term. A few wins at high leverage can train your brain to believe you are skilled when you might just be lucky in a friendly regime. Regime means the market environment, like calm trending markets versus choppy volatile ones. Regime shift is when that environment changes, and it always changes. Let me define leverage in plain terms. Leverage is borrowed exposure. It lets a small amount of capital control a larger position. It magnifies gains, and it magnifies losses, and it magnifies emotions. The key risk is that losses compound against you. A 50% drawdown. Drawdown means peak to trough loss, requires a 100% gain to get back to even. That asymmetry is why position sizing is not optional. It is the core of risk management. A lot of people think the goal is to be right. The real goal is to be wrong in a controlled way. Every strategy has a distribution of outcomes. Distribution means a range of possible results, not one result. Even a great trader has losing streaks. Paul Tudor Jones has talked publicly about defense and staying in the game. Stanley Druckenmiller has emphasized not just making money, but not losing money in a way that breaks you. They are not saying never take risk. They are saying take risk that you can survive. The simplest sizing mistake is confusing conviction with probability. Conviction is a feeling. Probability is a rate based on evidence. Base rates are what usually happens in similar situations historically. If you ignore base rates and size on conviction, you are letting your mood set your exposure. That is behavioral finance in action. Behavioral finance is the study of predictable human mistakes around money, like overconfidence, loss aversion, and recency bias. Recency bias is overweighting what just happened, like assuming the last month will repeat forever. Now think about volatility. Volatility is how much price tends to swing. A position in a quiet utility stock is not the same as a position in a high beta tech name or a leveraged crypto token, even if the dollar amount is identical. If you size by dollars instead of by risk, you end up accidentally concentrated in the most unstable instruments. Good sizing respects volatility. It also respects correlation. Correlation is how two assets move together. When correlation rises in a crisis, diversification can vanish right when you need it. This is where real history helps. Long-term capital management, LTCM, was run by very smart people. They used leverage on trades that looked low risk because the spreads were small. A spread is the price difference between related instruments. Their models assumed correlations, and liquidity would behave like the past. Liquidity means the ability to buy or sell without moving the price too much. In 1998, liquidity dried up, correlation snapped toward 1, and small spreads moved violently. They were not just wrong. They were too big. Position sizing turned a tough period into an existential event. Rogue trader stories are also position sizing stories, even when the headlines focus on fraud. Nick Leeson at Barings took positions that grew beyond control, well hidden, and rolled forward. The firm did not have effective limits, independent risk checks, or a culture that forced losses into the open early. Incentives mattered. If a desk gets rewarded for profits and quietly tolerated for hidden risk, it will drift toward disaster. A good sizing policy is not only a personal rule, it is also a control system. It defines maximum loss, maximum exposure, and what happens when those limits are hit. Let me bring it back to a normal trader at home. You have a finite bankroll and a finite nervous system. Your sizing has to fit both. People underestimate the nervous system part. If your position is so large that you cannot sleep, you will not follow your plan. You will cut winners early, hold losers too long, and revenge trade. Revenge trading is when you increase risk after a loss to try to get back to even quickly. It feels rational in the moment, but it is usually just loss aversion. Loss aversion is the tendency to feel losses more intensely than gains, which pushes people to take bad risks to avoid admitting a mistake. So what does good sizing actually do? It keeps any single trade from being able to ruin you. Risk of ruin is the probability that a sequence of losses wipes you out or drops you so low you cannot recover. Risk of ruin depends on your win rate, your payoff ratio, and your bet size. Payoff ratio is average win compared to average loss. Even with a positive expected value means average outcome over many trials. You can still go bust if you bet too large. That is the brutal part. A good strategy plus bad sizing equals failure. There is a famous concept called the Kelly criterion. Kelly is a formula for optimal bet size that maximizes long-run growth, assuming you know your edge and the odds. In real trading, you do not know them with precision. That uncertainty matters. If you size at full Kelly based on noisy estimates, you can overbet and suffer huge drawdowns. Many professionals use fractional Kelly, meaning a smaller fraction of that theoretical size, because estimation error is real. Estimation error is the gap between what you think the probabilities are and what they actually are. I want you to notice something. The market does not pay you for taking risk. It pays you for taking compensated risk, risk that has a positive expected value. A lot of risk is uncompensated. Uncompensated risk is exposure you do not get paid for, like being massively concentrated in one name, or holding a leveraged position into an earnings event without an edge, or holding illiquid assets that gap down when everyone runs for the exit. Position sizing is how you choose which risks you can afford and which risks you refuse. Consider Warren Buffett. He is often described as concentrated, and he is. But his concentration sits on a base of deep understanding, long time horizon, and usually no forced leverage. Forced leverage is when margin calls can make you sell at the worst time. Buffett can ride volatility because he is not a leveraged tourist. The average trader using margin is different. A 20% drop can become a margin event. That is not philosophy. That is mechanics. Now consider George Soros, famous for big macro bets. The public remembers the size, but the professionals remember the risk control. Soros has written about reflexivity, the idea that market participants influence the fundamentals they are reacting to. In reflexive markets, moves can feed on themselves. That creates tail risk. Tail risk is the chance of extreme outcomes, the kind that happen rarely but dominate results. When tail risk is present, sizing has to assume you can be wrong in a bigger way than your model expects. This is why I care about convexity. Convexity means your payoff is asymmetric. You can make more when you are right than you lose when you are wrong, like certain option structures. Convexity can allow larger sizing because losses are defined. But many traders think they have convexity when they do not. A stop loss is not a guarantee, it is an intention. In fast markets, stops can slip. Slippage is when you get filled worse than your stop price. Gaps happen. liquidity disappears. Your real loss can be larger than your planned loss. So when you size for the world that can happen, not the world you prefer. Another sizing trap is adding to losers without a risk plan. Sometimes adding can be rational, like scaling into a long-term investment with cash flow and no leverage. But in trading, adding to a loser often turns a manageable loss into a career-ending one. Jesse Livermore is a classic example people cite, and his story is complicated, but one lesson stands out across many eras. Big losses often come from being too big too early, with no room for the market to breathe. I also want to talk about concentration and diversification. Diversification means spreading risk across different bets. It works when the bets are not perfectly correlated. But diversification is not a free lunch. If you diversify into things you do not understand, you add hidden correlation and hidden tail risk. The goal is not many positions. The goal is independent sources of expected value. Sometimes that means fewer positions sized appropriately. Sometimes it means more positions with smaller risk each. The key is that no single idea gets to decide your fate. A practical way to think about sizing is in terms of damage tolerance. How much can you lose on a trade and still execute the next 100 trades with discipline? That number is usually smaller than people want. It feels slow. But slow is what compounding needs. Compounding is growth on growth. It works best when you avoid deep drawdowns. Deep drawdowns create a hole that requires increasingly heroic returns to escape. Heroic returns usually require heroic risk, and heroic risk usually ends badly. Position sizing also has to adapt. When volatility rises, your size should usually fall.